Every morning, while you are pouring your second cup of coffee and scrolling through your phone, something quiet is happening in New York. Not a headline, not a breaking news alert, just a click. Another investor submits a withdrawal request from a Blackstone fund and gets one response. Please wait. The money exists. You just cannot have it right now. This is not a glitch. This is the first crack in a $3 trillion system that was never built to be stress tested. And today I want to show you exactly how deep that crack goes, why it connects to the price of oil, to your retirement account, and to a secret that has been sitting frozen on a government balance sheet since 1973. Most people have never heard of private credit markets. When most people need a loan, they go to a bank. Banks are regulated. There are rules about risk, about capital, about transparency. But over the last 20 years, a shadow version of banking quietly grew up beside the traditional system. Companies like Blackstone, Apollo, and Blue Owl started doing exactly what banks do, lending money to businesses, real estate developers, and infrastructure projects, but without the rules, without the oversight, and without the transparency. Where did they get the money to lend? From pension funds, insurance companies, and from everyday retirement investors with 401ks who had no idea their savings were funding high-risk, illiquid loans. The returns looked great during the era of cheap money, so more capital piled in. The market grew from basically nothing to $3 trillion in about a decade. Now, the era of cheap money is over. Rates are high. The economy is slowing, and investors want their money back. Here is the problem. These funds are not bank accounts. Private credit loans are locked into long-term illiquid contracts. When everyone tries to exit at the same time, the fund cannot sell assets fast enough to pay everyone out. Blackstone just hit a record number of withdrawal requests from its $82 billion credit fund. So high that Blackstone had to use its own corporate money and employees' personal funds just to cover the gap. Blue Owl completely stopped redemptions on one of its retail funds. BlackRock began limiting withdrawals, and Jamie Dimon, CEO of J.P. Morgan, said on his last earnings call, "When you see one cockroach, there are probably more." That is not the language of a man who thinks everything is fine. To understand why this matters beyond just these funds, you need to understand what leverage does in a connected system. Think of a homeowner who bought a house for $500,000 with $50,000 down. Leverage 10 to 1. If the house drops just 10% in value, 100% of their equity is gone. That is what leverage does. It amplifies the upside and destroys the downside. Now apply that to the entire economy. The homeowner has a mortgage. The bank borrowed money to lend it. The private credit fund holding those loans is leveraged. The insurance company that invested in the fund is leveraged. And the government above all of this carries $38 trillion in debt. Every layer of the system is borrowed against the layer below it. A tower of cards, built on cards, built on cards. And here is the historical fact that should keep you up at night. In 2008, it was not the entire mortgage market that collapsed. It was roughly 4.5% of total mortgage loans that went bad. 4.5% was enough to take down the entire global financial system. That is the domino effect inside a leveraged world. Today, the dominoes are bigger. Right now, two threats are converging at the same time. The first is oil. Thanks to the war in Iran and the partial closure of the Strait of Hormuz, through which 20% of the world's daily oil supply passes, prices are rising again. And throughout modern history, a sharp rise in oil has preceded almost every major recession. It happened in 1973, in 1979, in 1990, in 2000, and in 2007, when oil hit nearly $150 a barrel, and the worst recession since the Great Depression followed. Every single time without exception. The Strategic Petroleum Reserve, which normally acts as the government's buffer to release supply and calm prices, has already been largely depleted. The safety net is gone. The second threat is quieter, but just as dangerous. Artificial intelligence is beginning to eat white-collar jobs. Finance, insurance, office administration, information technology. These are not factory floors. These are the people who pay the most income taxes, carry the biggest mortgages, and keep consumer spending alive. It does not take everyone losing their job to start a chain reaction. It just takes enough. A handful of industries displaced at the wrong moment, and the dominoes start falling on their own. And when those two threats hit a budget that already does not close, you get a real problem. Think of it this way. Imagine you earn $100 a month. 70 goes straight to obligations you legally cannot cut. Another 30 goes to interest on a credit card you have been maxing out for decades. And you still owe 20 more for something non-negotiable. You are already spending more than you make before buying groceries. That is the federal budget right now. If income drops even slightly, because of a recession, because enough taxpayers lose their jobs, the government cannot cover its basic obligations without printing. And printing right now is more dangerous than it has ever been, because oil is volatile and elevated. If the Fed cuts rates to fight a recession while oil is simultaneously rising, inflation comes roaring back. The Fed can defend jobs or defend prices, not both at once. That is checkmate. So with a cracking private credit market, rising oil, a trapped central bank, and a budget that does not close, what can the government actually do? The answer might already be sitting on a balance sheet, frozen at a price set in 1973. The United States officially holds 8,000 tons of gold, the largest sovereign gold reserve in the world. But on the official books of the U.S. Treasury, that gold is valued at $42.22 per ounce, a number that has not been updated in over 50 years. The real market price of gold today is above $5,000 per ounce. This is not an accounting mistake. It is deliberate. Gold competes with government bonds. When gold rises, it tells the world, trust the metal, not the debt. For a country that needs the entire world buying its treasuries, that signal is dangerous. So the official price stays frozen. But that frozen number is also a lever. The Treasury could reprice that gold to market value overnight. One accounting decision transforms the reserve from $11 billion on paper to over $1 trillion in real assets. No printing press, no new taxes, no new borrowing, just a change in the number on the ledger. If this sounds impossible, it has already happened 3 times. In 1934, Roosevelt repriced gold overnight, giving the Treasury an instant balance sheet boost without borrowing a single dollar. Nixon did it again twice in the early 70s. Each time it was used as an emergency tool when no other good options remained. Then, silence for 50 years, while the market price climbed from 42 to 5,000. And there is a second layer to this that almost nobody is connecting. A repriced gold reserve could also stabilize oil. The petrodollar system, the deal where oil producers price their oil in dollars and park profits in U.S. treasuries, is under pressure. The dollar is less attractive. Treasuries are less attractive. So what if the U.S. offered something different? Paying for oil not in depreciating paper, but in gold repriced at a dramatically higher level. At the right ratio, oil producers receive more real purchasing power per barrel than they get today. Oil stabilizes, inflation cools, the Fed gets room to move, and none of it required a single dollar printed from nothing. In 1973, right after the Arab oil embargo, European countries were already planning exactly this. The United States blocked it because they needed oil priced in dollars. Now the U.S. itself is the one with no clean options left. Here's what that means for you. The system is not broken. It is performing exactly as a system that has borrowed against its own future is supposed to perform when the future finally arrives. And when they restructure it, when that $42 number finally moves, the people who saw it coming will be on the right side of the ledger. The people who stayed inside the system, trusting paper, will be the ones funding the reset. My name is The Bull. Come for the finance, stay for the truth. Hit the like if you want to know which assets win the day. That number finally changes. I will see you in the next one. Stay sharp, stay cold, and keep your eyes on the gold.